Hello everyone, this is Osama Rizvi and welcome to another episode of the Monday Macro View. I thought it would be really nice to take a stock of where the global economy and global economic indicators stand at the moment, because there has been a lot going on in terms of soft landing, rumors of soft landing, rumors that or claims that the global economy is now recovering. However, things on the ground seems absolutely opposite. So let's dive in right now. First of all, look at this slide. The red slide shows, the red line shows the headline inflation rate, and the blue one, the percentage change in US oil prices. And although there has been a lot of talk about the apparent decoupling of oil prices and the inflation expectations, the United States of America or around the world, I do not think that such a decoupling has been possible. Even if there is, that might have been certain instances. So what is happening right now is that oil prices seems to have broken their $90 psychological mark, which is a good news in many ways. It shows strong a strong demand recovery and sort of these things. But if you look in the medium to longer term, this would actually usher in increases the likelihoods of a recession, because the higher the oil prices, the inflation would remain higher, or it would remain sticky, forcing the Fed and other central banks around the world to continue, or at least make their interest rates where they are right now. So they won't change it anytime soon. That would eat away at the savings, which already seems to be diminishing, as we have spoken about it in the previous shows, and that might turn into a recession. And we're going to talk about recession throughout this slides. The second chart also looks at the recession probabilities across the asset classes and how they have changed recently. So we started from a recession probability of about 80-90%, and now, as things stand at the moment, it has come down all the way to 15 or 10%. I think it all matters where you look at. So one of the senior analysts at JP Morgan, he recently, in a note to its clients covered by Financial Times, he actually mentions that how the global economic indicators or the overall orientation of the economy is more susceptible to recession than it was previously before. And he says the risk of interest rate shock and monetary tightening are clear. Consumer credit, within it, auto loans, credit card loans, student loans, this seems to have been exacerbated. Real estate globally, in commercial and residential, both in the developing market and the emerging markets, have taken a dent. Funding of startup and small businesses have shrunk. Increased volatility has increased, certainly, and the same was echoed by the chairperson of or some official of the Financial Stability Board, who said that the global economic recovery is actually losing momentum, quote unquote. So, and there was also another article in the Barron's Daily which was really well written, and it called for a very sane approach, that it is too soon to open up the champagne bottles, because if you look at the global south, if you look at the developing countries, you look at one indicator. So in the past 2 decades, there were 19 defaults, whereas in the past previous 4 years, there have been 15 such defaults. And, there are lots of other factors to it as well. So clearly, on the grounds, things aren't as well. This can be seen with the recent report, where it said global business activity was still down. You look at UK services PMI shrunk to a level not seen since January 2023 this year. And this was also echoed in France, where manufacturing activity slowed down. And if you look at the next slide, this speaks about Germany. Germany is a country which we have been following quite keenly, because Germany is the economic powerhouse of the Eurozone, and German industrial production actually fell slightly more than expected in July, and the production fell about 0.8% compared to the previous month, and people were expecting around 0.4, 0.5% decline. You have manufacturing, you have construction activity decline, you have production of capital goods that have declined, and Germany, along with the Eurozone, seems to be entering into a full-fledged recession once again. Speaking of recessions and important countries, major economies, we can't miss out what's happening in China. So exports from China also dropped This is the fourth month that the exports have dropped consistently. Although it was better than previously. So previously we had about 14.4% drop in exports, and similarly in imports. Now the double-digit decline has been changed into a 8.8% decline in exports and 7.3% decline in imports. So you can see there are two ways to read these things. One, China's economic condition and the momentum seems to be improving. However, it is still not there where it's supposed to be. You can see on this chart, look at the figures at where they stood at in April, and look at where they stood in right now. And July is the actual bottom that we hit. So things seem to be turning, but we don't know how much time it is going to take. You look at the global industrial production, it also took a downturn. Global industrial production and containerized freight flows remain low in the third quarter as well. The volume of world trade actually was down by 2% compared with the last same period last year. And in the United States of America, the volume of container trade handled through the 9 largest ports in July was the lowest for the time of the year since 2017. The volume at the US ports, 9 largest US ports, were lowest since 2017. And globally, even industrial activity and freight still seem to be flattening after the merchandise-led boom. And now all the pressure seems to be on the services sector, and which, by the way, we've covered recently, is also not doing pretty well. Finally, this is a really interesting chart by Votexa, and it shows the OPEC Plus cuts, and this speaks to the first slide that we actually did. So this was a very interesting point, but David Weck, if I'm pronouncing his name correctly, from Votexa, I follow him on LinkedIn quite diligently, and he made 2 very good points. So if you're looking at the supply cuts of OPEC Plus, we have to take into account 2 things. How much of the announced cuts are really implemented, and how do these cuts interact with the rest of the market fundamentals? So from that perspective, it seems that it isn't really realistic to assume that Saudi Arabia which is actually sharing the biggest gain of these cuts, biggest chunk of the cuts, will continue to do so even till the end of the year, because in doing so, they would probably the oil prices would hit beyond $100, and that would not be a good spot for anyone in the world. Finally, economists seem to be divided on the ramification of the inverted yield curve. Some are expecting that, as previously stated, it is a really good indicator of a recession, but now things seem to be, things seem to be heading the other way. Look at the market sentiment tracker. It still remains fairly balanced, with the bearish side, the recessionary side, actually overweighing slightly the bullish side or the recovery side. I think this rumors of soft landing are gaining traction, but as we have just seen, the original, the on-the-ground situation remains precarious. So that's all from today, and I'll see you all next week.